What is a mortgage? A mortgage is a loan that's used to purchase a home. So the cost of the mortgage is based on the term of the loan, meaning is it a 10-year, a 15, a 20-year, a 30-year, or in between. There's all different term times available to get. Most people get a 30-year term. The longer the term is, the smaller the payment is. So a 15-year term, you'll pay it off in 15 years, but you're going to have a much higher payment than if you have a 30-year term. You own the home. The home is in your name. It's your asset, but you pay the lender to pay it off. Just like when you have a car loan, it's your car, but you're paying off the loan. The home is collateral. If you stop making payments on the home, please don't do that. Then the bank can foreclose on the home and it's terrible for your credit. You lose your home and so on. So make sure that no matter what, you always prioritize making your home payments. There's a variety of mortgage loan types. So we have the typical ones that people know about, a conventional loan, which is backed by Fannie Mae or Freddie Mac. There's also an FHA loan, which there are three government loans. I'll go through them. We've got FHA, which is backed by the Federal Housing Administration. We have the VA loan, which is guaranteed by the Department of Veteran Affairs. And we have the USDA loan, which is guaranteed by the U.S. Department of Agriculture. Each loan has its own qualifications. For conventional, generally you want to have a credit score around 700 or more if you're putting down less than 20%. For FHA loans, if you have a lower credit score maybe, then you'll probably be better off in an FHA loan. If you've served our country and you're eligible for the VA loan, then you definitely want to look at that. That's a zero down loan. USDA is also a zero down loan. However, USDA does have strict guidelines on your income and your debt to income ratio, which I'll talk about in another video, but real quick, it's just basically how much debt do you have compared to your income. When you are going to look at getting a loan for a home, definitely compare different loan products. If you don't fit in the box of a typical mortgage loan, there are different options available. There are 1099 loans, bank statement loans, there are investor loans, loans that are excellent for self-employed borrowers, and there are even down payment assistance programs available. Let me know if you have any questions about any of these. How do you get a mortgage? First of all, you'll need to provide information about yourself, your finances, your income, your residential history to a loan officer. They will then take your information and evaluate your credit history, your income, what type of income you earn, how much you earn, and your liabilities and your assets. We need to make sure that you have enough for down payment and closing costs, and we need to make sure that you're not over leveraged as far as liabilities. One thing that happened before 2008 is that people were allowed to borrow as much as they wanted and they didn't really consider the liability issue. Consumers were not protected. After 2008, several laws were changed and we have a lot of regulations now to protect consumers. And so there are guidelines that we adhere to make sure that you have enough to pay your bills, pay the mortgage, and have enough to live on. We do not want to put consumers in a situation where they cannot afford a home. When you get a mortgage, we determine how much you qualify for and we verify that information with your documents.